Now, a rollover treasury bills auction is expected to hold at Nigeria's fixed income market today with 69.6 billion naira on offer. And I have Bukky Aregbesola. She's the head of fixed income at Access Bank. She joins me now to discuss what we can expect from today's auction and more. Thank you so much for your time today, Bukky. Let's get into that treasury bills auction. 69.6 billion on offer today. What's the sentiments looking like?
So we expect the DMO to oversell, and we expect that the rates would go up. This is the trend we've seen over the past few weeks, especially on the one-year tenor. We expect that the rates should trend up as high as 9.5, and then that they would sell more in order to take the rates up.
Looking at how this compares with other ones, though, how do you think this is going to impact the secondary market activity?
I mean, what we've seen in the secondary market is also a continuous increase in yields, and demand has been very, very thin because the sentiment for investors is, since rates are going up every auction, they can actually wait to fill their order from the next auction.
All right, then let's get into something else that I'm also quite keen to know here. We've seen the central bank resume dollar sales to the foreign portfolio investors. Last time we saw this happen was sometime in December, I think the 20th. But what do you make of this move, and what's the gameplay here from the central bank?
Well, it only makes sense that they should sell. The FPIs have been anticipating these sales for quite a while, and I think it's a good move by the CBN that they are beginning to sell to the FPIs. We expect that this would also impact the fixed income market because the FPIs would need to sell down on their treasury bill positions in order to be able to pay for the dollars.
Right, now, looking at the sentiments for the markets this week, though, you say funding rates are expected to remain elevated in the absence of any significant inflows. Can you clarify?
Yes, that's the expectation. And I mean, this is what it has been for months now. Rates have been in the double-digit region, and we don't expect anything to change anytime soon.
All right, now, but for bonds, though, what's your outlook, and how is that repricing playing out across the curve?
For the bond market, what we've seen this week, and especially today, is a reaction to the thin liquidity in the money market and also the bond offer calendar that was released by the DMO for the quarter and also for this month's auction. So the expectation is that DMO is going to be buying more bonds this quarter, and this has led to an increase in yields in the market, added to the fact that liquidity is very thin. So this has also impacted on yields. However, DMO has some options. So they could either not sell as much as we expect, or they could use non-competitive requests to manage the rates at this month's auction. And if that happens, we expect that we'll see a retracement in secondary market yields, even if it's only temporary.
All right, now we're expecting the inflation figures for March tomorrow, though. What's your house call, and what kind of impact do you think it's going to have?
I think inflation has been priced into market yields, but again, especially if the rates go up, it would only solidify market sentiments, and we'll continue to see an uptick in yields, which is why any management of rates by the DMO would only be temporary until we start to see the inflation rate coming down.